It didn't begin with a press conference. There was no speech, no warning, no dramatic announcement sent to newsrooms around the world. What happened first was something far less visible: a delay here, a document quietly revised there, export approvals that suddenly took longer than usual, language inside regulatory notices that felt different. Nothing that would trigger an alert on its own, nothing that would make headlines. But taken together, the pattern felt wrong. In global trade, real shifts rarely announce themselves. They surface as friction, as hesitation, as small interruptions that don't make sense at first glance. And over the past weeks, people who live inside supply chains began to notice exactly that. Traders asked questions and didn't get clear answers. Logistics firms flagged anomalies they couldn't easily explain. Manufacturers adjusted timelines without publicly saying why. It was subtle, almost invisible, and that's precisely what made it dangerous. Because when systems that normally move with mechanical precision begin to hesitate, it usually means something upstream has already changed. This wasn't panic yet, it was confusion, and confusion is often the first signal. Most people assume global decisions start with headlines. They don't. They start with paperwork, with internal approvals, with language that shifts just enough to create uncertainty without triggering alarm. That's how pressure is introduced quietly. By the time the public notices, the decision is already embedded in the system. What made this moment unusual wasn't just the delays themselves, but where they were happening. Certain export pathways, certain approvals, certain materials that rarely face friction suddenly encountering resistance. No explanation, no denial, just silence. And silence in geopolitics is never empty. Silence is space. Space for recalibration. Space for leverage. At first, analysts dismissed it as routine bureaucracy, seasonal adjustment, technical backlog. That's what you say when you don't yet have a story. But those explanations began to collapse under scrutiny, because routine bureaucracy doesn't cluster, it doesn't align across sectors, and it doesn't appear at moments when global supply chains are already under strain. Something else was happening, and whatever it wasn't designed to be loud. This is how modern power often moves, not with confrontation but with constraint, not by breaking the system but by tightening it just enough to feel the pressure. The signal wasn't meant for the public, it was meant for those who understand how fragile global flows really are. And once you recognize that signal, the next question becomes unavoidable. What exactly was being positioned? And why now? Because when trade slows without explanation, it's rarely an accident, it's a test. To understand why those early signals mattered, it's necessary to step away from politics and look at something far more concrete. The material at the center of this story isn't rare in the way people usually imagine scarcity. It doesn't disappear from the earth overnight. It doesn't belong to a single country, and yet its movement through the global system is far more fragile than most realize. Silver is often misunderstood. For many, it still lives in the shadow of gold, a store of value, a historical metal, something associated with jewelry or investment coins. But that perception stopped being accurate a long time ago. In today's economy, silver functions less as a symbol and more as an input. It is embedded deep inside modern infrastructure, inside electronics, inside energy systems, inside precision manufacturing. Remove it, and entire production lines begin to slow. This is not theory, it's engineering. Silver is one of the most conductive materials used at scale. That single property makes it difficult to replace without sacrificing efficiency, durability, or cost. In industries where margins are tight and tolerances are narrow, substitution is not a simple decision. It's often not a decision at all, which is why silver doesn't move like other commodities. Its flow is tightly synchronized with manufacturing cycles. Contracts are long-term, inventories are lean, stockpiles are smaller than most assume. The system works only because movement is predictable. When that predictability breaks, the effects are not immediate, they are delayed, and that delay is what makes the risk difficult to communicate. Factories don't shut down overnight, products don't vanish instantly. Instead, timelines stretch, costs rise quietly, insurance clauses are reviewed, procurement teams start asking uncomfortable questions. That's when concern replaces confidence. What complicates the picture further is concentration, not just of supply but of processing and refinement. Raw material is only one part of the equation. The ability to refine, certify, and move that material at scale is what gives it strategic weight, and that infrastructure is not evenly distributed. For years, global markets optimized for efficiency. Cost reduction, speed, redundancy was treated as waste. The assumption was simple: flows would remain open. That assumption no longer holds. Silver sits at the intersection of technology, energy, and manufacturing. It doesn't dominate headlines because it doesn't trade with the drama of oil or the symbolism of rare earths, but its absence is felt quickly by systems designed around continuity, which is why even small disruptions matter. A delayed shipment here doesn't trigger panic. A revised export approval there doesn't collapse markets. But when those disruptions align, when they affect the same material across different pathways, professionals inside the system notice, and they start recalculating risk. This is the context missing from most early reactions. The story isn't about hoarding or speculation. It's about dependency built quietly over decades, dependency that works until it doesn't. By the time the broader public begins to ask why prices are moving or why companies are issuing vague statements, the internal assessments have already shifted. The system doesn't wait for confirmation, it responds to probability. And once silver enters that probability space, the conversation changes. Because control over flow, even temporary, even partial, introduces leverage. Not through force, but through timing. And timing in global trade is everything. When attention finally began to shift toward Beijing, there was still no announcement to point to, no press briefing. No official statement designed for international audiences, no single document labeled as a turning point. That absence was not accidental. China rarely introduces strategic moves through spectacle. Power in the system is exercised through process, through administrative adjustments that look routine to outsiders, but carry weight for those who know where to look. This is not new, but it is often misunderstood. In Western political culture, major decisions are typically framed as events. They are announced, defended, debated. In China's system, decisions are embedded first, explained later, if at all. The priority is execution, not narrative. What began to surface were subtle shifts in regulatory language, not bans in the dramatic sense, but clauses that widened discretion, approvals that became conditional, reviews that no longer followed predictable timelines. On paper, nothing appeared confrontational. In practice, flexibility was being removed. This approach serves several purposes. It avoids escalation, it preserves plausible deniability, and it forces counterparts to react without a clear target to respond to. You can't protest what hasn't been declared. You can't retaliate against what hasn't been named. That ambiguity is not a weakness. It is the mechanism. Inside China's policy framework, export control does not always function as a blunt instrument. It operates as a valve. Flow is adjusted, not necessarily stopped. Pressure is applied selectively, often invisibly, and the timing matters. These adjustments didn't occur in isolation. They arrived during a period of heightened global sensitivity around supply chains, technology dependencies, and strategic materials. Every major economy was already watching its vulnerabilities more closely, which meant even minor changes carried amplified significance. What made this moment stand out was coordination. Multiple agencies appeared to be moving in alignment. Not quickly, not loudly, but consistently. The kind of movement that suggests internal consensus rather than reactive decision-making. There was no rush, and that too was telling. Urgent responses are often defensive. Measured ones usually aren't. From Beijing's perspective, the objective isn't disruption for its own sake. It's leverage without liability, influence without confrontation, a reminder of position without forcing a response that could spiral. This is where many external observers misread the situation. They search for intent in speeches or headlines, when intent is encoded in procedure. A revised guideline here, an added review step there, a temporary hold framed as technical. Each action is defensible on its own. Together they form a signal that doesn't need translation. China is not signaling panic, it is signaling control. And control over flow, especially in a system optimized for constant movement, doesn't require permanence to be effective. Even uncertainty can be enough. At this stage, markets were still calm on the surface. There was no immediate reaction that justified alarm, but beneath that surface, risk models were being adjusted, because once policy becomes discretionary rather than automatic, assumptions break down. And when assumptions break down, pricing follows. The move wasn't designed to dominate a news cycle. It was designed to reshape expectations, quietly. When headlines finally began to form, one name surfaced repeatedly: Apple. For many observers, that became the story. A familiar company, a visible brand, a symbol people recognize immediately, and symbols are easier to process than systems, but focusing on Apple misses the point. What unfolded was not a reaction to a single company's exposure. It was a response to what that company represents inside the global economy. Apple functions as a reference point. Its supply chain is among the most scrutinized in the world. Its production cycles are studied, modeled, and mirrored by countless other firms. When stress appears there, it is interpreted as an early warning, not an isolated issue. That's why concern surfaced quickly. Not because Apple was uniquely vulnerable, but because it is deeply embedded. Any disruption that affects its inputs raises questions about everyone else relying on the same pathways. This is how market psychology works. Participants don't wait for confirmed damage. They respond to asymmetry, to situations where information is incomplete but risk is no longer evenly distributed. In this case, the uncertainty wasn't about volumes or prices yet. It was about access. Could materials still move freely? Would approvals remain predictable? Would contracts written under old assumptions still hold? Those questions travel faster than facts. Suppliers began reassessing exposure. Insurers reviewed clauses tied to delivery risk. Procurement teams quietly explored alternatives that, until recently, didn't need to exist. None of this appears on a stock chart immediately, but it changes behavior. And behavior, not announcements, is what moves markets. What many called panic was, in reality, recalibration, a shift from confidence to caution, from optimization to resilience. Apple's visibility simply made that shift visible. The reaction also revealed how interconnected modern production has become. A single adjustment in one segment forces reassessment across multiple layers, not just upstream suppliers, but logistics, financing, and even currency hedging. This is why narratives centered on one company fall apart quickly. The real concern was systemic. Once the possibility of constrained flow enters the conversation, the question becomes not who is affected first, but how far the effect travels, and whether mitigation is possible without significant cost. Markets are not good at pricing ambiguity. They prefer clarity, even bad clarity. In this case, clarity was absent by design. That absence created space for speculation, and speculation fills gaps faster than data ever can. Analysts offered scenarios, commentators debated intent. Each interpretation slightly different, each contributing to volatility. But underneath the noise, professionals were focused on one issue: dependency. How much of current production assumes uninterrupted access? How quickly could adjustments be made if that assumption fails? The answers to those questions were uncomfortable, which is why Apple remained in the headlines, even as the real issue expanded far beyond it. The company wasn't the cause of concern. It was the lens through which concern became visible. And once that lens focused attention, the narrative could no longer be contained, because this was never about a single brand reacting to a policy shift. It was about how quickly confidence can erode when control over movement becomes uncertain. As reactions spread across markets and supply chains, a different kind of conversation began to take shape. Not about prices, not about companies, but about patterns. Because for those who track global trade over long periods of time, this moment felt familiar, not identical, not predictable, but recognizable. Major disruptions rarely arrive as singular events. They emerge through recurring structures, control over movement, strategic concentration, gradual tightening rather than abrupt shutdowns. The specifics change, the mechanism doesn't. Over the past decades, globalization rewarded efficiency above all else. Production was optimized for speed, cost, and scale. Redundancy was reduced. Inventories were minimized. The system became faster, leaner, and more interconnected. It also became more fragile. That fragility doesn't reveal itself during periods of stability. It shows up when control points are tested, when access becomes conditional, when assumptions built into contracts and forecasts no longer hold. What unsettled observers wasn't just the possibility of restricted exports. It was the reminder that control over flow has quietly become one of the most powerful tools in the modern economic landscape. Not tariffs, not sanctions in their traditional form, but discretion. The ability to decide when, how, and under what conditions something moves. That power doesn't require permanence to be effective. Even temporary uncertainty can reshape behavior. Companies delay decisions, markets reprice risk, governments reassess dependencies they had preferred not to examine too closely. This pattern has appeared before across different sectors and regions, not always with the same materials, not always with the same actors, but always with similar consequences. The initial response is denial, then minimization, then quiet adjustment. Only later comes recognition. What makes the current moment particularly sensitive is timing. The global system is already absorbing multiple pressures: energy transitions, technological decoupling, financial tightening, political fragmentation. Each pressure alone is manageable. Together, they reduce margin for error. In that environment, even small constraints carry outsized impact. The lesson markets have learned repeatedly is that dependency becomes visible only when it is challenged. Until then, it remains abstract, something acknowledged in reports but rarely acted upon. This time, the challenge wasn't hypothetical. The structure of global trade was being reminded of its own design choices. Choices that favored concentration over diversification, speed over resilience. And those choices don't unwind quickly. That's why comparisons began to surface, not as direct parallels but as warnings, moments when access, rather than ownership, became the central issue, when leverage came not from possession but from permission. What unsettles systems most is not confrontation, but uncertainty about rules. And here the rules were no longer automatic. This doesn't mean collapse is inevitable. It does mean adjustment is unavoidable. History shows that when flow becomes conditional, the system adapts, but adaptation comes with cost. Economic, political, strategic. The discomfort visible in recent reactions wasn't about immediate loss. It was about recognition. Recognition that the environment has changed, even if the surface still looks familiar. That recognition tends to arrive slowly, and once it does, it reshapes decisions long after the headlines fade, which is why this moment mattered. Not because it was unprecedented, but because it wasn't. At this stage, no one inside the system is working with certainty. What dominates decision-making now is probability, and probability forces scenarios. Escalation in this context doesn't necessarily mean a dramatic announcement or a permanent shutdown. More often it appears as extension, as duration, as scope slowly widening. The first area to feel pressure would be contracts. Agreements written under assumptions of uninterrupted flow suddenly require reinterpretation. Clauses related to delivery timelines, force majeure, and substitution come under review. Legal teams move quietly, long before any public acknowledgement is made. This is where cost begins to rise, even without a visible shortage. Insurance premiums adjust, financing terms tighten, risk models are recalibrated. None of these changes make headlines, but they alter the economics of production. The second pressure point is inventory strategy. Companies optimized for just-in-time delivery are forced to reconsider stock levels. Holding more inventory provides security, but it also ties up capital. That trade-off becomes unavoidable when access is no longer guaranteed. As more actors attempt to buffer risk simultaneously, demand appears to increase even if end consumption hasn't changed. That dynamic alone can distort markets. The third layer is political response. Governments rarely act first. They observe, they collect signals, and they wait for confirmation that a pattern is no longer temporary. If escalation is perceived, responses tend to follow familiar lines. Diversification initiatives, strategic reserves, diplomatic engagement framed as technical cooperation rather than confrontation. These responses take time, years, not months, which means the adjustment period matters more than the outcome. A prolonged phase of uncertainty forces companies to make decisions without clear guidance. Some will overreact, others will delay. Both choices carry risk. Markets respond unevenly to that kind of environment. Volatility increases not because fundamentals are unclear, but because expectations diverge. One group prices disruption, another prices normalization. Both can be wrong. The final pressure point is psychological. Confidence is difficult to measure but easy to lose. Once participants believe access could be constrained again in the future, behavior changes permanently. Long-term planning becomes more conservative. Exposure is reduced where possible. That shift doesn't reverse easily. Even if conditions stabilize, the memory of constraint lingers. It becomes part of institutional decision-making, a factor added to future risk assessments. This is how escalation reshapes systems without visible confrontation, not through crisis but through recalibration. It's important to note that none of this requires intent to dominate or punish. Escalation can emerge simply from overlapping responses. One adjustment triggers another, each justified in isolation. Together they create friction. The system absorbs that friction until it can't. Where that threshold lies is impossible to predict. But history suggests that prolonged uncertainty, rather than acute shock, is what drives structural change. Which is why the question is no longer whether escalation is dramatic. The question is whether uncertainty becomes normal. And if it does, the global trade environment that emerges afterward will not look like the one that existed before. Looking back at how this story began, the contrast is striking. What started as minor delays and procedural adjustments evolved into a broader reassessment of how much confidence the global system can still afford, not because of what has happened, but because of what no longer feels guaranteed. The early signals mattered precisely because they revealed stress without spectacle. They showed how easily flow can be influenced without confrontation, and how quickly uncertainty spreads once assumptions are challenged. This moment is not defined by a single decision or a single country. It is defined by exposure. Exposure of dependencies that were tolerated as long as movement remained automatic. Exposure of strategies built on continuity rather than resilience. Exposure of a system that functions smoothly only when trust and access is universal. What has become clear is that neutrality in global trade is increasingly fragile. When materials essential to modern economies move through discretionary frameworks rather than fixed rules, predictability becomes a privilege rather than a baseline. That shift doesn't announce itself, it embeds itself. The system is not breaking, it is being tested, and tests rarely produce immediate failure. They reveal limits. They show where flexibility exists and where it does not. They force adaptation, often quietly, long before outcomes are visible. What makes this phase particularly important is that it does not end with resolution. Even if flows normalize, even if restrictions ease, the memory of constraint remains. Decision makers adjust. Risk tolerance shrinks. Redundancy becomes valuable again. Those changes alter the shape of global trade over time, not through shock, but through accumulation. This is why the significance of this moment cannot be measured by short-term price movement or headline intensity. Its impact lies in how expectations are rewritten. Once the idea of conditional access takes hold, it becomes part of future calculations. And once that happens, the system operates under a different logic. Whether this episode remains a footnote or becomes a reference point will depend on what follows, on whether discretion expands or contracts, on whether uncertainty fades or becomes institutionalized. For now, what can be observed is simple. The global system is adjusting to a reality where flow is no longer assumed. And when that assumption disappears, every participant is forced to rethink position, exposure, and strategy, quietly.